Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run.
Nobody sees that coming. Nobody's pricing Bank of America equity right now at 10% treasury yield. In fact, if you want to have some fun, go ask Grok. Hey, Grok, which is, X's AI. Tell me what the situation looks like for Bank of America if treasury yields go above 10%. How could the bank survive?
Oh, and this is important because this guy is telling us that there's a big a possibility of a collapse of Bank of America coming, and I'll let him finish. I'll let him finish.
Because if there is a failed auction ever, or if the Fed has to come in and start buying again, which is what they will do, the inflation expectations are going to go crazy, and no one sees this. There will be a run on Bank of America, and there will be a day where the ATM machines do not work. And by the way, people say, "Oh, that could never happen." Bullshit. It happens all the time. Fractional reserve banking systems fail all the time. They're built to fail. And that's what happened in 1932. And of course, what did the government do? The government seized all the gold in the country in 33. So I see a clear set of circumstances, like I did with Fannie Mae and Freddie Mac, that to me, the numbers are crystal clear. What's different about America as opposed to Japan in 89 is Japan had like a 25% domestic savings rate. They had enough domestic savings that they could afford for their government to be 200% plus of GDP in debt. We can't because we have no domestic savings. Total domestic savings in the United States is less than $5 trillion. Less than. There's no way we can refi 11 trillion plus in bonds in 1 year because we don't have the domestic savings to do it, which means we depend on the kindness of strangers. And yet, what are we doing? We're pissing in those strangers' Cheerios. That is not good treasury management. And I'm telling you, this will happen this year. The Fed is going to have to go in to buy bonds again. And when that QE, quote unquote, starts again, the long-term yield on treasuries is going to go well above 6%. I think it'll go above 7%. Could easily go above 10%. Nobody sees that coming. Nobody's pricing Bank of America equity right now at 10% treasury yield. In fact, if you want to have some fun, go ask Grok. Hey, Grok, which is, X's AI. Tell me what the situation looks like for Bank of America if treasury yields go above 10%. How could the bank survive? There's a reason why the world's best informed investors.
Okay, so can you explain what? So he said that so people aren't buying treasuries. He's saying so China is actually dumping their treasury bonds, right? And he's saying that the other countries aren't buying them, so the Fed is going to have to go buy them. And that's going to raise the yield, which will lower the price of them, and that's bad. So is that am I close to what he's saying?
So that was a lot of information, and I feel like everyone's head probably is about to explode after listening to that. So there's kind of two pieces of this, and I'm happy to take it in whichever order you'd like. We can talk about the run on the bank and why, like what happened with Silicon Valley Bank, why that is potentially analogous or not analogous to Bank of America.
Talk about that.
So let's talk about that first, and then we can address the issues with the debt because they're definitely related, but they're two different issues. And he's sort of conflating a lot of different things that I think if we don't understand the basics, are going to be challenging. So if you remember back in 2023, we had a major banking crisis and Silicon Valley and some others went bankrupt. There were bank runs and the Fed had to step in to basically secure, quote unquote, the financial system. And so what had happened was that all of these people during the easy money times went and they deposited their money at the bank. And then, the bank said, okay, well, I need to do something with this money. Well, normally the bank makes loans, but if they don't have enough loans to make, then they want to put it into something that is quote unquote safe. And what do? They put it into these treasury bonds that we're talking about, as well as mortgage-backed securities in some cases. Now, the case with Silicon Valley Bank, what had happened was a couple of things. One is that when people decided that they wanted to get their money back because the rates started going up, maybe they wanted to invest in a treasury bond instead or a money market fund, or maybe their economic situation changed, all of a sudden Silicon Valley Bank was forced to sell some of these treasuries. And as we said, if you hold them to maturity, it's not a problem for Silicon Valley Bank. But if you're forced to sell them because people want their money back and you don't have that money back to give them without selling the treasuries, then you're selling at a loss. What happened?
Because the price of that bond has gone down.
Exactly. And if the rates went up, so the bond price went down.
So the price that they paid for it, they're not going to recoup that money.
Correct.
And so that's where the loss comes in.
And that gets a loss and then compounded against their customers. So normally, if there's a little bit of that, it's not a big deal. What happened with Silicon Valley Bank is not only was their business model really focused on deposits, it was something like 90% of their liabilities were these deposits. And then of those liabilities, 93% of those, Jimmy, were not FDIC insured. So the people who had their money in the bank freaked out. They knew, if I'm not the first person in line, that all of these aren't insured and that money is at risk and that there's a potential loss. And there was a run on that bank, and that's what ended up bringing it down. So if you take that and you apply that to Bank of America, what is different about Bank of America, and I'm not saying it doesn't completely absolve them, because they do have an insane amount of treasuries on their balance sheet, and there are a lot of issues with our financial system, and I'm not opining on that, but just so that people can understand the difference is that Bank of America has less of their liabilities and deposits. They have a more diversified business line. I think compared to the 90% of Silicon Valley Bank, it's something like 70% of Bank of America. But they have far fewer of those counts that are not FDIC insured. I think that their rate the last time I saw was under 40% versus 93% from Silicon Valley Bank. So, if you have that insurance, you're less concerned about, I have to pull this out, and there's less of a need to quote unquote make a run on the bank. So that creates a little bit of a difference. The other thing is that the Fed, if you remember, stepped in and they created this program to basically backstop the banks. Bank of America, is, as he said, the banking system. They own a piece of the New York Fed. I mean, they're entrenched into the system. So that the idea that the Fed wouldn't step in if something happened with Bank of America, which is less likely than Silicon Valley Bank, but certainly not, completely improbable.